What's up? What's up? Hey, what's up, Ranjit and Michael? TikTok has me banned on live streams until Friday afternoon because of sexual activity and nudity on the live stream yesterday. None of that happened. I have no clue what's going on. Grant says, "What's Dixie?" Dixie is the chart that shows. Let me see if I can pull it up real quick. It basically gives the strength of the dollar compared to the other currencies of the world. Um, let me minimize this quick. There, no. Where's my shit? Must be here. Gotta be here, right? Let me pull up the Dixie real quick. If I can get TradingView to load. Come on. Should have restarted my computer yesterday. And they don't this chat only stays on here with this screen that you're seeing right here. So every time I put it down, I don't see this stuff. A wild live stream. Yeah, it was a good one. It was a really good live stream. But all of a sudden, after being on for like 3 hours, that's what TikTok does. It just goes, your live streams all of a sudden just shut down. And I'm like, what the fuck? And it puts the reason as sexual activity and nudity. And I'm like, what? We're looking at charts all day. And then in the last 30 minutes, you're looking at me, like I looked literally like this, and I'm just talking. Like, what? TradingView is giving us some lag here. So the Fed meeting, the Powell will walk out in about 7 minutes, it looks like. Yeah, my computer's just moving a little slow. I should have restarted. I should have restarted it last night or whatever. Let's go to the, come on, Dixie. Maybe I said Dixie. Maybe that's what happened. I don't know. But what's funny is I wrote TikTok, I peeled it, and then I wrote their support, and they're like, blah, 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 you're still until Friday. And I'm like, you guys don't even review that shit. I mean, how could you? It's a 3-hour live stream. But if you're going to accuse me of it, surely your algorithm is going to flag some moment in the video. Anyways, come on, fucker. Load. What the hell is the problem here, TradingView? I'm not sure what's going on here. Let's just do this. Yes, go there. Dixie chart. Oh, that was an old alert. Come on, Dixie chart. I'm still in quarantine from COVID. If you're leaving comments right now, I will get to them. I just don't see them because the screen is minimized and I can only see them down there. If anyone has good suggestions on other live streaming software, please let me know. I use OBS. I guess that's what everybody uses, apparently. Oh, there it is. Oh, there it is. Come on, man. What's the deal? Jesus. All right, I don't know. I've never had this problem with TradingView until yesterday. That's why I needed to restart my computer. Anyways, let's go over that. What is the Dixie? It's a basket of all these currencies, and it compares their value to the U.S. dollar value in terms of buying power. So when the dollar goes up, that means these are worth less in terms of buying power. Maybe this will give us a chart. Maybe MarketWatch will show us. It's not going to be as good as the trading, but yeah, see this little spike that just goes whoo. As soon as that report got published, it just goes boom like that. Get out of here, get out of my face. It just goes like that. It was down here at like probably about actually it was in the 110s, but then it just shot up here. And right now it's sitting at 111. So if we chart this over, come on, let's go over a year. It's just been going up. So we just set another high. And as the Dixie goes up, the real significance of that, as the Dixie goes up, Where OBS go? As the Dixie goes up, all risk assets go down. The Dixie is like the value of cash going up, and then bonds go up with it, treasury bonds. Everything else goes down. Stocks, equities, cryptos, gold will go down, commodities will go down. Everything that's priced in dollars goes down. Like if, oh, this is worth $1,000, but if dollars are worth more now, then it's not worth $1,000, it's worth like $900. That's what keeps happening because everything is relative in its value. The denominator is the dollar, and if the dollar keeps going up in value, then the other things go down relative to the dollar. No, Grant, no, you get what I'm saying. If Bitcoin is worth $20,000, right, and dollar is worth this in terms of buying power, and if the dollar's buying power goes up, anything that's denominated in the dollar goes down. It has to, because if the dollar can now buy more, things have to be priced in lower amounts of dollars, especially risk assets like stocks and cryptos. And yes, real estate. Watch out, real estate market. I've been saying this for so goddamn long, and you guys have been hearing me say it. Real estate is going to go down. I'm not talking about crashing or collapsing. I just mean it's gonna go down. It's been going down. Even though shitloads of people, I'm in the real estate industry. I have a real estate business. I don't want it to go down, but I have to look at reality so I can plan for it. Yeah, it's just not good, Grant. Like, if the more buying power a dollar has, the lower cost in dollars something needs to be, right? If the dollar has a certain amount of buying power, then you can buy a burrito. If it has more buying power, then you can buy 2 burritos, because the burritos are now cheaper relative to the buying power of the dollar. If the Dixie goes up, Dixie and bonds go up. So what this says is it's a good idea to have cash. Cash is the best thing to have right now, cash and bonds. Everything else is going down in value. Literally everything else. The meeting should be starting in, I got it started over here already. It should be starting in a minute, literally a minute. Wish I could pull up some charts. Let me look at my phone quick. You can see what some charts are doing over there. ETH's back to about 1337, about where it was before that run up happened. I told you guys in the Discord this morning that I placed some longs this morning. Those were nice. I had preset profits put in place, and I moved my stop as it shot up 1 minute before the meeting minutes got published. But the numbers that came out there, that meeting will start in a second. Let's look at these numbers real quick. So now the Fed, this is very big, look at this. The Fed is saying, look, we expect GDP to only go up 0.2. This is a big correction from what they had last time, right? We haven't had a Fed meeting since July, right? Since July, it's been 2 months. They really altered these numbers and said, all right, we expect much lower GDP, right? So that was so we only got the 0.75 rate hike, but all these numbers are what made everything go kablammy. And I think that why the markets are going to continue to decline for the rest of this week, frankly, till I don't even know when. I don't know what's going to make the markets go up at all. If not this, because look at this too. Check this out. So they think they haven't gotten into reality about employment numbers yet. But when you look at where's their projected rate? Look at their projected rate by 2023. Hell, by the end of the year, they expect to be at 4.1 to 4.44. Interest rate. Oh, I can hear the meeting. I can hear the meeting right now.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone.
I got some coffee delivered.
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer
They're
run
not willing to
normal
say we're
growth
going
rate.
into recession yet. But
Despite the
are.
slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated.
But they know unemployment's got to
Job
rise.
gains
They know
have been
it.
robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Markets are going up right now.
But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June.
Whole 1%.
The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Wow. Sorry, you're going to get unemployed.
Hi, Chair Powell. Thank you for taking our questions.
There.
Gina Smilik from the New York Times.
Gina first.
I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
Good question.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. Yep. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. the way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you can see pausing? Is it linear that you keep raising rates, or is there, oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Sure. Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time, but we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Okay, Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether Also, do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick?
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Yeah.
Howard?
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
Oh.
So
Question.
we make one decision per meeting, and the decision we made today was to raise the federal funds rate by 75.
But you're right. That's the way it'd have to play out.
You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
Yeah, all of that.
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now. If you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
Good question. You want to answer it?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that that we put together, that our staff puts together, and that we put together on our own, always take all of that, try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people,
we need everybody to spend less money.
That they really are suffering from inflation.
So if you're unemployed, you'll spend less money.
If we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
But how will you know, or will you know, if you've gone too far?
He won't.
Hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks, Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability, and you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion. And this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much. And that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain. As we go forward, Americans be prepared for that economic pain.
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year, expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
Back there. Look at his face.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
That's the hope.
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
Sure. So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Okay. All right. What's up, Dom? I just see you're in here now. So, to me, there's no reason to be long right now. There's no reason to be expecting green candles. Could the market be ridiculous and go up in this unexpectedly bad report that just came out? Yeah, of course. But it doesn't make any sense. It wouldn't make any sense. Let's go to the report real quick. Yes, high Dixie does mean lowered Bitcoin. So let's go back to this report real quick. So here's their report, right? So I don't know what this was in June, but this number was certainly higher. This is them saying, well, we're only going to have a slight positive GDP for the year, which is just them avoiding saying, because if they choose anything else, we're in a recession or stagflation. No, it wouldn't be stagflation. Yeah, it would be. It'd be stagflation. And then they expect growth. So they know that's not true. They just have to put these numbers in there because they can't create pandemonium. They know those aren't true. They know these aren't true. They know that these are going to go up. They want these to go up. They want this to go down because although making these go down and these go up will lower inflation. So here's the PCE inflation, the core. We already know that stuff though. And then where's the projected? Here's the federal funds rate. They expect to get up to 4.4. Is that right? No. Here we go. 4.1 to 4.4. Yeah, up to 4.4 by the end of the year, which that's why that guy was saying, well, then you've laid out your cards. Apparently you're going to do a 75 basis point in November and a 50 basis point in December. Either way, based on this projection right here, they plan on doing another 125 basis points, 1.25% to what they already have. Right now, we're at 3%. We're at 3% right now, 3 to 3.25. That's what they'll say because it varies a little bit every day, but we're at 3%. And for the longest time, people said, and myself included, I wasn't sure if we would ever even get to 4% because we were like, they're going to have to get it to like 3.5, maybe 3.75 because the federal government cannot take a 4% interest rate because of their debts. The federal government owes $31 trillion. The interest payments alone on that debt at 4%, do you know how much that is? 4% on $31 trillion? It's over $1 trillion. Over $1 trillion just in interest payments a year. The GDP of the U.S. is what? I shouldn't say the GDP. The income of the government is about $4.5 trillion a year. So you're talking about 25% of the government's income being paid out in interest rates by the Fed funds rate. And then the Fed still plans. Look at this. The Fed still plans on raising interest rates higher, getting up to as close to 4.9% by the end of 2023. Wow. So these are the numbers that are making the markets go crazy. And these are the numbers where I sit here and I look at these and I go, there's just no way anyone, even the most bullish person, can look at this and go, all right, I'm buying today for the short term. There's no way this, and nothing here indicates a bottom. This indicates, we have lower to go, straight up. We're talking about, well, most people didn't think we would ever even get to a 4% interest rate. Seriously, I was very unsure of it. I wasn't sure if we'd actually get over 4%. And now the Fed's saying, oh yeah, we're going to get over 4% by the end of the year, and we're going to get to almost 5% possibly by the end of next year. Holy shit. Holy shit. Drop some comments in there. Grant, there we go. Yet we keep on giving and giving to these countries, and ours fall further into debt and taxes go higher. It's true. It's true. It's true, man. It's true. And there's that. It's also that we're the world reserve currency. And so that comes with great power, comes great responsibility. So we do have a responsibility to other countries, to plenty of other countries in the world. So it's not as simple as that, but yeah, it's the thing is us raising our interest rates. If you think it's hurting us, everywhere else in the world is getting absolutely annihilated compared to us. I did a TikTok yesterday, and I like to be asking people, because people from all over the world, typically we'll have people come in from literally every continent, tuning in, even Africa, tuning in, and I'll ask them what gas prices are. In Europe, everyone's paying about $7-8 a gallon. I mean, they do it in euro or pounds per liter, but do the math, and it's about $7-8 a gallon. Africa, though, was paying we're paying about $4 a gallon. And I'm like, that's interesting. Australia was paying, I think, about $6 a gallon. Asia, I don't know. I don't know what they're paying. They might be doing good. If you're in China or India, you might be doing good because you get Russian oil. So, I don't know. But I agree. In no way am I defending the government, by the way, Grant. The reason we're in these debacles is because they massively misuse funds. They make poor decisions that are short-sighted. They make decisions that are good for them or good for their buddies. And it's just... But that's where we are. That's where we are. And now this is the situation. Inflation's sticky, so we'll wait for the next... Everything looks bearish, like extra bearish. I didn't think it could be more bearish today. I didn't. I thought, okay, if the Fed does 100 basis point, all right, well, that's pretty bearish. That'll make the markets go down. They didn't do 100 basis points. They did 7.5 like we expected, but it was the projections that altered, right? They drastically lowered their expected GDP, which means like they literally lowered it to the lowest number they could without saying we're going into a recession. They know we are in and are continuing to dive further into a recession. They just can't admit it because it does not help them. It's not about not telling the truth. It is, but it's also about we can't admit this yet because it's too early, and all the other factors here that we can't control, such as public perception, it'll make things go nuts. So we can't do this yet. We have to control this thing. That's what they're doing, and I understand. I do. The unemployment, they had to way underreport that. Like, okay, well, we have this strong thing going on, and by the end of the year, and that very well could be correct by the end of the year. Maybe that's all that is unemployment-wise by the end of the year, but they know damn well unemployment is going... I'd be shocked if unemployment didn't get to at least 6% by, summer next year, with the potential to get up to like 10%, crazily. There's just so much more pain coming. There just really is. And there's only so much they can do, Sean, it was 75 basis points, but the big news was those things I said and the forward projection for what interest rates are going to be, right? Let me show that again real quick. So this is what the Fed thinks the interest rate is going to be by the end of the year, 4.1 to 4.4, and then by the end of the next year, 4.4 to 4.9. So these were just ratcheted up. So now no one expected this, right? Wall Street expected this number to be 3.8. They did not expect a 4 handle at all, let alone this fucking monster over here. So everyone just got smoked. And me, I mean, granted, I didn't know what to expect either. I was kind of like, okay, well, that's probably what's going to roughly happen. But I'll say this. I'm going to give a little bit of a clap. Like Fed, overall, I understand you can't come out and say we expect GDP to be lower for the year because we're in a recession. I understand you can't say that. You just can't. And you have to be a little light on those job softening report you got there. I understand that. But I appreciate you coming out and just saying, spanking, this is what the interest rate's going to be. Oh, it's more than you thought? Boom, good. Because quit fucking buying stocks. Stop floating this money around. We need inflation to come down. Your assets need to drop. What's up, Jeff? And going back to Grant's comment way up there, everything's up 2 to 5%. That's true. I don't think that's very long-lived. I already see things coming down because I've been watching the ETH price this whole time. ETH made its way up to 1380s. When I started the stream, it was at like the low 1300s. Made its way up to 1380s. It's worked its way back all the way down to the 1340s. Now it's at about 1353. But I don't see any scenario where there's a reason for green candles. Euro went from $1.20 all-time high to, let me see if I can squeeze this thing over so I can read all these comments. Can I make this like bigger? My chat bar here, not quite. Oh, can I do that? No, that didn't do anything. Oh, wait. Oh, there we go with the chat bar. Like this infinity screen thing you got going on. I don't know what else to do. It's what it does when you pull up OBS like this, because the only way I can see not myself, it's the only way I can see myself, but that doesn't matter. The only way I can see the comments over here, because if I minimize this, oh, there it still is. But if I click something, it's still there. See, it disappears. But I guess that works. Okay, I guess it came back, so I can minimize that. And we can go over here and scroll a bit, okay. If I can get you to stay up, that'd be great. I think it's going to go back down. Small pump, sell the news. Yeah, I mean, I wouldn't even call it sell the news. I mean, what news? The news is all bad. The news is not bad. It's what needs to be here. It is bad for markets, I guess. Okay, ETH's at 1351.52 right now. I expect red candles for. I don't even know. I don't know what would stop the red candles. Like why? Right. We have the next CPI next month. We've got the next FOMC meeting in early November. That's the next FOMC meeting, 6 weeks from now. And the CPI report would be in, I don't know, 2-3 weeks from now, something like that. And then we're going to start having earnings. We're going to start having earnings reports coming out. We're talking stock market stuff. I don't think those are going to be rosy. So I just don't know. I don't know. Unless I'm wrong about earnings. Unless earnings are expected to be better. I don't know. Hey, what's up, Richard? I wish it was 1%. I wish it was 1%. I think just get this shit up. And then stop raising. It was another 75, yep. But that's not the big deal. The big deal is these numbers over here. They drastically lowered their expected GDP for the year and the following years. They increased their expectations for unemployment rate, so they think more people will be unemployed, even though I think these numbers are low. And I think all these numbers are wrong, I think. But the point is that they adjusted them. And I understand that political-wise they have to do this. But down here is the big sauce. Down here, excuse me. So by the end of the year, the Fed expects the Fed interest rate to be anywhere from 4.1 to 4.4. What? Wow. And then by the end of next year to be possibly all the way up to almost 5%. Whoa. These numbers got adjusted. Nobody saw this coming. Nobody saw this coming. Everybody thought it would be some kind of 3 handle. The Fed says, boom, we're going to do 4 handles on y'all. So it's just, That is the big one. All of this is just saying the Fed says, listen, inflation's a problem. We think we're going to head into a recession. We think unemployment rate's going to go up. We need to raise interest rates now. We need to lower demand. We need to lower demand big time. We got to really start raising this thing. So what they said is, because what Wall Street, et cetera, expected was a 0.75 today. They expected a 0.75 today, and then they expected a 0.5 in November and a 0.5 in December. What the Fed published here says, well, we give you your 0.75 today, but we're also going to give you a 0.75 in November, and then a 0.5 in December. So an extra 25 basis points, the Fed's saying they're going to do higher than anyone thought. And subject to change. They could go higher. I don't think so. I don't think they can get any more. They were so hawkish. The sentiment was so hawkish leading into this, and it just got more hawkish. That's all I got to say. Yeah, Ada's Vassal is 100% priced in. 100%, dude. 100%. Shit gets, that's one thing that I really try to teach people, and I learned this the hard way, you know. Shit gets priced in so much earlier than most people think it does. So, yeah. I mean, if this wasn't, like, say this meeting today wasn't priced in, we would have still been up. ETH, for instance, would have been still up at, you know, I don't know, fucking 1,600 or, I don't know, although the merge was very priced in. It started to decline in price a day or two before the merge actually happened, and it's been going down ever since. So stuff gets priced in. It definitely does, right? And the maximum priced inness happened, in August, a whole month before the merge. Now that coincided with the stock market rallying and peak inflation and all that stuff until Jackson Hole. You know, which maybe 1% would have been a crash, but over for you personally, I can't speak, but for everybody else, for the entire actual macroeconomic landscape, it would have been, in my opinion, what do I know, seriously. But I think 1%, just get this shit up and quit fucking around and just let it play out. Now ETH is down to 1343. It's going to keep going down. It's going to keep going down. Sam, I welcome countering perspectives, that's for sure. Could you please elaborate on why you think it was very dovish? Because I just have a hard time seeing the Fed lowering their expected GDP, raising their expected unemployment, raising their projected interest rates looking forward. I just have a hard time as interpreting that as anything but like smack you in the ass hawkish. And I know what you're talking about with the bullish divergence. I saw that too. I've been looking at that. But it's, I have to go with what got reported here. I mean, we could see more green today, but those are playing with numbers by big bank accounts, and then it'll be red. And it's already getting red. ETH's down to about to break 1340. Going to get back into the 1330s to 1340 and 1338. So, yeah, I think ETH is going to get into the 1200s, maybe 1100s, and that's about that. I follow ETH mostly, obviously. But Sam, if you're still on here, I would definitely like to hear why you think it was very dovish. Because if you're going to make a statement like that, please elaborate. Anyone else got any comments? I'm probably going to hop off here pretty soon. I'll be back live on TikTok Friday afternoon, like later afternoon. Because yesterday TikTok, I was about 3 hours into a live stream, and then all of a sudden my live stream got shut down. I'm like, what the hell? I'm like, what did I say something mean to somebody or something? And it says shut down for sexual activity and nudity. And I'm like, what? What were you looking at? Because what you're looking at right now, this is what you were looking at. This is what was going on right here. This and charts on the screen. That's it. I'm like, so I appealed and I wrote them, and they still kept it down and keep me banned until Friday. And I'm like, I hate centralization. I really hate it. I didn't do anything, Jeff. It's just maybe someone reported me falsely, and I don't know, and maybe TikTok. I don't know how it all works, but I definitely didn't do anything. I'm just enjoying the background talk as I type my report. What type of report, Grant? Oh, my back. I think I'm feeling better. I think I'm feeling 95%, by the way. No, I've not checked out Opt 2. It's hard for me to overstate how uninterested I am in 99.99% of DeFi projects. The only DeFi projects I'm interested in this very bearish market is Curve, Aave, Uniswap, probably Compound, probably Convex, and I might be missing one more, and that's all. That is absolutely all. Very much blockchain gaming. Very much blockchain gaming, NFT gaming. You've always been good on there. Thought maybe he ran amok. Yeah, it's just they do dumb shit. Like, I get videos taken down sometimes that are just like ridiculous, and they put most of them back up, but they can't. I don't know how they would really review a live stream. I think they just kind of say fucking on those. Call the mom of the guy who rented it, and the guy is already going return it. Interesting. Are you insurance or police or something, Grant? Yeah, blockchain gaming, Richard. Like, because being able to own your actual in-game assets, that doesn't even say it big enough. Doesn't even come close to saying how big it is, really. But I mean, imagine you can own businesses within games, right? Because in games you go to merchants and trade your gold for weapons and stuff, or for cloaks or for items. Like, well, what if that merchant was actually a real person like me, and it was my shop, and we did that trading, and you traded me a currency, right? The in-game currency, which is also a crypto coin that is worth real world dollars. And the game, this is the most important part, the game is absolutely fucking fantastically fun. Fantastically fun. I mean, as good as any game on the planet. That's the thing that most people don't get. This whole play to earn thing is bullshit. I hate the term play to earn. I hate the idea of play to earn, because you're playing just to earn. That is not sustainable at all. But just adding an earning component into fantastic games, not even an earning, an economic component that is translatable to the real world. That is fantastic. Because in a regular game, I'd never want to be a merchant. There's no benefit in that for me. What do I do? Well, like, how would I do that? But in a game with NFTs on the blockchain, I'm now a real merchant, and I'm getting real money, and I'm acquiring real assets, and I have real assets, and I'm selling real assets, and they're buying real assets, they're using real assets, they're up leveling real assets, they're going on quests, they're going on missions, going and finding jewels, going and finding in-game currency, going and finding treasure that it actually has real value. they're getting land to farm at, right? We have taverns, we have camps, we have places because people need to sleep and eat within the game to get energy to rest because these are mechanics of the game. It's a metaverse. Blockchain gaming is the metaverse. Police. There we go, Grant. Last night, funny enough, I had like four police cars just right at my door. Not because of me. They'd caught some people vandalizing or something, and then they were just sitting around bullshitting after, like blocking a pretty major road in Seattle, like just sitting there bullshitting, like standing there. It was late at night, so whatever. But I'm like, why are there like 4 police cars right at my front door? Like literally, I could have spit on them. Not that I would do that, but I'm just saying to show how close they were. And then I went out and talked to them to see what was going on. That's how I figured out about the vandal thing. I'm like, what's going on? Anything I should know? I keep checking out Alluvium. Got in the beta to check it out. Alluvium looks good. But I don't have anything invested in Alluvium. Why? This is just my own personal take, right? These are just my opinions. It's the most focused on game in blockchain gaming. I feel like it's too hyped. I feel like it's going to be a good game. Absolutely. But I feel like it's not where the best opportunity lies. So I'm not involved in it, and I really don't see myself getting... I might buy a little Alluvium coin or something. But there's a few other games, 4 in particular, that I have been tracking for quite a while that I feel are pretty undervalued. 2 of them in particular, very undervalued, and one of them wildly undervalued. If you guys, some of you probably know what I'm talking about, which game I'm talking about. I think East's about to go under 1330. More power to you. Live in Seattle. Here the crime is very bad there. I don't know if it's really any worse than anywhere else. It's gone up because we were a bunch of, we didn't really have much for crime past 10 years. But it's went up for sure. It's definitely went up. Yeah, ETH just went under 1330. I just see red, man. I just see red candles. I wish Sam must have left. I really wish I don't know if he's just trolling or what, but I wish he would have elaborated on that if he actually meant it. Or maybe he's just talking shit. I don't know. But that's it right there. Things were hawkish. Things were hawkish going into this, and somehow it got I thought the only way it could get more hawkish was if they did 100 basis points. I was wrong. They didn't do 100 basis points, and it got more hawkish than if they had done 100 basis points. Seriously, the only way to make today more hawkish was if they did 100 basis points, but it really kind of wouldn't have mattered because the forward projections, they basically said, here's what we plan on doing in November and December and 2023. They gave us the forward look, and the forward look was more hawkish than we thought it was going to be. So, yeah. Yeah, I don't consider it high crime. I just, it's gotten more homeless. And the police have their hands tied a lot more ever since 2020 when, George Floyd and the whole everything popped up. And granted, George Floyd was in Minneapolis, but nonetheless, that started a nationwide rioting. And we had a police station actually get completely taken over here, a sector called, and they ended up calling it the Autonomous Zone. And ever since then, the police have really had their hands tied. Do you think Fold will ever start doing ACH payment rewards? They keep talking about it. I think eventually they will, but I don't know how they can make that work. Because when they do ACH, they definitely don't, I'm not a payment processor, but I don't think they make any money from that. So I'm not sure where they would be paying from. They certainly don't have a high incentive to get that going. They talk about it. I think eventually they will, but I don't know. All Metros battle live in South Louisiana, the country. Yeah, shit. I don't know much about Louisiana, but it doesn't seem like the lowest crime state in the world, in the country, In Cali, yeah, absolutely. Yeah, I think Seattle is a lot like the Bay Area, but a smaller Bay Area that's not as developed into the problem. It doesn't have the problem being as developed yet because same issues. The tech scene has taken off so much here in the past 10 years that the median income and just overall cost of living inflation has gone up so much that it's caused a big income gap. Yeah, Jeff, you're gonna start making your car payment that way. Yeah, I agree, man. That would be you. Yeah, I mean, maybe I'm assuming your car company must charge you an extra fee if you use your Fold card. But yeah, I would like to. It's exactly why we'd want to do the ACH payments to pay stuff off like that. I mean, there's maybe some workaround with depending on Jeff, depending on who your car loan servicer is. You could possibly use PayPal. Because you load your Fold card into PayPal, and you might be able to use the ACH payment thing on PayPal or something. I don't remember exactly how it works, but Fold had an article showing you how some people can pay their mortgages and stuff with their Fold card using PayPal and get their and not get charged a fee by their servicer and get their rewards. And they talked about with cars too. So look into that, Jeff. I would say look into try to find that Fold article about using PayPal to pay off mortgages and cars and stuff. I moved to Florida to get away from that all. I mean, I've never lived in Florida, but that's not the first place that pops in my mind to like get away from strangeness. But I mean, hell if I know. I mean, I've never lived in Florida. I've been to Orlando. I've been to the Gulf side. That's about it. I would think if you really wanted to get away from it all, you'd move to like Wyoming, you know? You're welcome, Jeff. Yeah, ETH is sitting down around 1330 now. I just don't see any reason why it would do anything but go red. So, yeah, I think the markets will continue to tumble. Yeah, I just don't see any other way. Yeah, right, Richard? Like, Florida man, all that shit. Yeah, I would think like Wyoming or something. Warm weather still. I mean, I would just think country. Maybe you're somewhere in the kind of more, maybe you're more rural Florida. Because if you're in any kind of urban area, you're just going to have this shit no matter where it is. To varying degrees. I mean, Baltimore, for one, is a place I'd certainly not want to be at. That's on the higher end of the spectrum of danger. You have Florida for no mountains, too flat. Nice beaches, though. Your dysfunctional family lives there. I hear you, man. Florida wouldn't be somewhere I could probably live either. I need mountains, but the beaches would be nice, that's for sure. And yeah, there's a lot of good things about it. Humidity, no thank you. Hurricanes, no thank you. But boy, those beaches. Tennessee, I could see that. Yeah, I could see that. I could see that as a getting away place. And they have mountains. You know, Appalachia goes through there. I mean, they're not as big as our Cascades, but they're still solid mountains, beautiful forest. And Tennessee's winters are pretty mild. My mother used to live in Kentucky, so I'm familiar with that area. And I think it was maybe 50s in the winter. Not bad. All right, I better roll. I'm glad to hop on YouTube today. Maybe I'll do a YouTube tomorrow since TikTok thinks this is nudity. Yeah, California beaches are great. That's true. California, you live in California. California beaches are great. Washington beaches suck. Oregon beaches are nice. Washington beaches suck. I believe it. With that being said, coming into that, I expect the Nashville and Knoxville real estate markets to be in the top 50% of housing markets hit by real estate declines. Phoenix and Boise and Austin seem to be the three that really come to my mind as ones that are just going to get smoked for that same reason. A lot of people from California moved there. People moved there. The whole remote work thing, trying to go somewhere where there's less of the bullshit. It's cheaper to live. It's still nice and beautiful. Maybe a better place to raise a family. That type of narrative and idea really caught fucking fire in the past 2-3 years. And really several years, but really got amplified in the last 2-3 years. So, Austin, Phoenix, Boise, those would be places that will also have the best opportunity if you wait. They will have the best opportunities to buy. For me, it'd be vacation rentals, Airbnbs. That's what I'd be looking for. Can you post that white paper doc in your Discord? Do I still have it up? See if we can find the Discord real quick. Hopefully I'm still logged in. Currently invest. Okay, cool. I don't give a shit. What's going on in Discord? Let's try that again. What's your deal? How you feel? How you feel? Like, come on now, I have it. Download it. Open Discord. I gotta restart my computer. There's just issues going on. And it should just load right up. I'll try to post it in there. I'll find it. I'll post it in there. All right, guys, I'm gonna go. I got a meeting here in a little bit. Maybe I'll go live on here tomorrow. Maybe. Let me know if you want to do that. Probably just do a regular, kind of look at some charts and shit. Other than that,